I'm always hearing from clients about cost segregation studies. Someone told me to do a cost segregation study, cost seg. And I love doing cost segregation studies. It's an awesome tax planning tool. However, there are instances where you actually don't want to do a cost segregation study, or at least not yet. And I'm going to go over a couple of those. The first reason that you may not want to do a cost segregation study quite yet is because of net operating losses. A net operating loss is actually when you create more deductions than you have income. And so a cost segregation study is something that could easily do this for you because it accelerates a lot of your depreciation deductions. It used to be for a net operating loss, when you had more deductions than you had income, that you could actually carry that loss over and completely offset income in the next year. Let's run through a quick example of how this used to work. So pre-2018, before the law changed, if you had, let's say in year one, whichever year that was, you had $1 million loss, which created $1 million net operating loss. This you were able to carry over into the next year. Let's say in the next year, you had $100,000 of taxable income before taking into account this net operating loss. So then because you had $100,000 of taxable income, you could use $100,000 of this net operating loss carryover, and that would give you zero taxable income after the net operating loss. So because you had used $100,000 in this year two to offset your taxable income, that meant out of your $1 million original net operating loss from year one, you now have $900,000 to continue carrying over. So now let's look at what this looks like now. So post 2017, or in other words, starting with net operating losses, this is the rule in place for net operating losses as of now. And this was all because of the 2017 Tax Cuts and Jobs Act. So essentially, you are only allowed to offset 80% of your income with a net operating loss carryover, regardless of how much of a carryover you have. So using our same numbers from our pre-2018 example, in year one, you have a net operating loss of $1 million. Let's say year two, you have $100,000 of taxable income. 100,000 times 80% means you can only use 80,000 of your NOL. So 100,000 minus the 80,000 that you can use to offset it means you're still paying tax on $20,000 of income in year two, even though you have $1 million net operating loss. So this means that you're carrying over now $1 million less the 80,000 that you used. So 920,000 can move into year three if you have income to offset. So essentially between these 2 years, if you look at them, the net is a $900,000 loss, yet you're still paying tax on $20,000 of income in year two. And this continues each year going forward. You can only offset 80% of the income. So in cost seg world, if you created this $1 million loss in year one because you did a cost segregation study, you may actually want to rethink doing it in another year, because you're not actually using those deductions in year one because you've created a net loss, you have nothing to offset. And then when you go into year two, you're not actually able to completely offset your income. So if you were to change the numbers around, say without a cost seg, you were going to break even in year one. Let's say it was zero income. So you push your cost seg, and let's say in year two, without doing a cost segregation study, you would have had $1 million of income. So we'll just make that correction. So this is $1 million, and this is without doing a cost seg. So say no cost seg. And we know because in year one, no cost seg was break even. So our cost seg results gave us $1 million. So this means if we do the cost seg in year two and assume the amount is about the same, then that gives you $1 million deduction in year two, which you can actually use to fully offset your income and pay no tax in year two. So as you can see, simply by shifting the timing of when you do this cost segregation study will substantially affect how much tax you pay potentially. So that's the first reason that you may not want to do a cost segregation study right away, Now let's go into reason number 2. The second reason you may not want to do a cost segregation study right away is because of passive losses. Obviously, most of the time this is for real estate investors, and rental real estate by default is deemed passive under the tax code unless you meet one of the couple exceptions. The first exception is active rental real estate, and what this means is that you can offset up to $25,000 of your other income if you are actively involved in rental real estate. Now, actively involved means that you are basically overseeing the property. You're either managing it yourself, you're overseeing the property manager, and that you are not pushing a bunch of responsibilities onto the tenant. So for example, if there's a repair, you would call and you would have someone go out there, take care of it. You would pay that contractor versus the tenant calling, scheduling, and then you simply reimbursing for that cost. If you were responsible as landlord, then that would not be a fact pattern considering you active. You have to actually be managing the property, having responsibility yourself, even if you're delegating those responsibilities to others that work for you. That would be active rental real estate. Now you can only offset $25,000 of your income, but not only that, it starts to phase out. Once you have up to $125,000 to $150,000, that begins to phase out. So in other words, up to $125,000, you could offset $25,000 of your income with active rental real estate losses. Then it starts, that $25,000 that you get starts phasing out dollar for dollar. So once you hit $150,000, you can no longer offset any of your other income with those rental real estate losses. So if you have a cost segregation opportunity with one of your properties, but it's going to give you more than a $25,000 loss and you're active, then you won't be able to use that entire loss. It will be a passive loss carryover. Or if you have more than $150,000, even if you do have active rental real estate, you're not going to be able to use any of those losses unless you have other passive income to offset. Passive income by default cannot offset your other active income. So that means it cannot offset your wages, or even what would be what some would consider as passive are not defined as passive in the tax code. So interest, dividends, potentially some capital gains from stock, retirement benefits, even though you're not actively involved in earning that money. As a simple example, let's just assume it's all rental real estate and you have two activities. Activity one, let's say, has a $10,000 loss for the year. This one is passive. You have activity two. This one is also passive, but it has $8,000 of income. So what this means, if they're both rental real estate, and let's assume you're not active or you're above the $150,000 limit for active rental real estate, then you could only use $8,000 of this. So really the net that you're going to pay tax on is you've got $8,000 from activity number two that you have income, and then you offset it with $8,000 of your loss from activity number one. And then that means your carryover to the following year is $2,000. So you can't use your full deduction. Let's do another quick example. But let's assume in this example that one of the activities you're actually actively involved in. So let's say you're running a business, you're materially participating, you're spending time in it, and then you also have a rental real estate activity. We'll call it active. You're active in the business, and this is activity number one. And let's say here you have $10,000 of income, this rental real estate, and this is activity number two. And here we'll use the same numbers, keep it simple. You have an $8,000 loss. In this case, if this one is passive and you're not active rental real estate, or you're above the $150,000 limit, then you would pay tax on that $10,000 from your active activity with income, but you're not able to use the $8,000 because this was passive. You can't offset the active income with it. So this is what you're paying tax on, is the $10,000. Your $8,000 from this passive activity would carry over until you had other passive income, either from the same activity or another investment. So you can see you really have to do some analysis of the types of income streams that you have, because if you're involved in a cost segregation study on this rental real estate where it's just going to create carryovers that you can't use yet, that means you're just spending money early that you could be using for other things, and wait until you can actually offset it. Maybe you end up making another real estate investment in activity 3. It's generating lots of income for some reason. Maybe it's a mobile home park. There's less depreciation deductions or something like that. And so then you're able to use the cost segregation study on your passive activity to offset it. So you have to do some planning around it. And a lot of cost segregation professionals that are just selling cost seg studies, they're not looking at this. They're just trying to sell you the cost seg, tell you how much deductions they can generate. But that's looking at it in a vacuum. You really have to have this holistic view at, basically your entire tax return and the income streams you have to really determine whether you're actually going to benefit. Cost segregation studies are an amazing tax planning tool. I've helped a lot of clients with them, and it helps them pay no tax a lot of times. But you don't want to waste your money with them also if you're not going to benefit now.